interest for you as we get ready to wind up 2020. As Matt reminded me, not much is going to change at the beginning of 2021, but I don't know, as an investor, kind of where's your head at?
So I'm still, I was listening to the clips earlier before you introed me, and I'm still amazed that people are confused that somehow the stock market and the economy are closely related. I thought that old myth was put to rest a long time ago. Your local economy is not reflected. The local restaurants that are closing, the small businesses, they are not reflected in the big market indices.
Why isn't it? Why hasn't that played catch up? That just kind of blows my mind.
So the big indexes are effectively market cap weighted, which is why it's Apple and Amazon and Microsoft and companies like that. The local dry cleaner that goes out of business, my favorite Italian place, Osteria Liana, just closed. They're not reflected in the actual indexes. In fact, even if you look at big, what we think of as day-to-day experiential parts of the economy, the gas stations and hotels and retail stores and travel, they're single-digit fractions of the index, whereas technology is 20-30% of, depending on which index you're looking at. So, gas stations, it's a rounding error. You could take the 50 worst performing sectors, industry groups, and eliminate them from the S&P 500, and it would only knock 6% off of the index. So it shows you that your day-to-day experience is so different than the actual indexes.
Yeah, I'm glad you hearkened back to the financial crisis. I was reminded, Carol sent me a story today on the Bloomberg about human-run hedge funds trouncing the quants, and I immediately thought of Ritholtz and, Josh Brown and Sal Arnuk and Joe Saluzzi. And, people picking stocks are actually doing better than these mathematical models. What do you think about it seems like the tech should have caught up and overcome by now, but they still just can't do it.
Yeah, I'm not going to make any friends with this answer, but even blind squirrels find a nut occasionally. All the data continues to come out, and it continues to say over long periods of time, stock pickers, they do pretty well in selecting stocks, but they're terrible at figuring out when to hold and when to sell stocks. And that's where the advantages of index show up. It's not so much the cost, although that's a giant factor, and it's not so much their stock picking prowess, it's everything else going forward. The beauty of indexes are they self-correct, they self-regulate. Companies that do really poorly fall out. Companies that do well get put in. Personally, I think they were late to the party with Tesla. They should have done that much earlier. It was pretty clear what was going on there.
Right.
But that said, it's very challenging. And the people who are outstanding portfolio managers and stock pickers because, they become household names mostly because they're outliers.
Barry, one thing I want to ask you, though, we have been in such a low rate environment for such a long time, at the same time that we've really seen the explosion in indexed assets. And I do wonder, we had guests on today that talked about the 10-year moving up a little bit, maybe 1.5 to 2. I do wonder, as rates, if they indeed ultimately kind of go back to more normal levels or start to tick higher, how does that maybe impact the trade? Does it then at that point, active management become something that is important and that the algorithms can't track as much? I don't know. How do you see it?
So you're raising like 3 really fascinating points within that. The first point is that go back to the .com implosion or the 08-09 great financial crisis, and in neither of those cases did active management distinguish itself. So the fact that we kind of came through a sort of a crash and recovery year, hey, third time's a charm. They finally did better this time. Number one. Number two, the fears that indexing is going to eat the world, and I've heard that a million times, hold aside the fact that most of the world is managed actively.
Right.
And indexes dominate ETFs, but they don't dominate bonds or real estate, and they certainly don't dominate how most equity is managed. But the fascinating thing is, as more and more people index, because it's set and forget and it's cheap and it's low cost and it's easy,
Right.
it creates the space for really good active managers to thrive. In fact, the more people index, the greater the inefficiencies are going to be overlooked by the indexers. So that creates alpha opportunities. And then the third and most
Wait.
fascinating
Hurry
thing,
up. You got 10 seconds.
the third thing is it really is a problem over time. You could do well 1 year, 3 year, 5 year, but the
Okay.
persistency hasn't been there.